case. The title of this case study is Can the World's Least Profitable Car Maker Turn Around? I'm curious what you think. I'm going to go through this valuation as a case study, and then I'm going to ask you to look at it and tell me what you think. Can this company turn around? What do you think? Well, let's check it out. Also, remember, you can leave a message in the chat for any question or the like, right? So let's see right here. I'm just going to say leave a question here. Feel free to leave a question in the chat. For the Valuation Master Class students that are taking the course right now, this is a case study to help you understand your valuation. And for those that are listening in, this gives you a chance to understand a little bit about valuation, but more importantly, what is happening with this interesting company. So I'm going to just make a couple changes here and see if I can get. Hold on. Got to figure out how to get it so it's side by side. Hold on. There we go. Okay. So now let's get into it. This is Andrew Stotts of A Stotts Investment Research, and welcome to the Valuation Masterclass case study, where we dig into interesting stocks and their valuations. Today's company is Tata Motors. We got a request for Tata Motors, so I thought, why don't we cover it and go through and understand it? So let's take a look. Remember, this video is for learning purposes only. This is not investment advice or a recommendation. Now, the title of this will say is Focus on Hybrids. The world is not ready for full EV. But let's take a look at the 3 things to know about this company. First, restructuring is challenged by immense cost pressures. Second, pure play approach to ride the EV or electric vehicle momentum. Third is easing of supply constraints fosters revenue rebound. So let's look at some of the key statistics of this company. First of all, there's 30 analysts that are covering the company, and the share price is in India Rupiah at 535. Upside is 7.3%, which is basically a hold. I would say analysts aren't that particularly excited. The price to book ratio is 2.1 times, and the dividend yield right now is 0, as the company's not paying out any dividend. So let's now talk about the revenue or the sales of the company so we understand the structure. The revenue breakdown for 2021, well, first is Jaguar accounts for 78%. Commercial vehicles count for 13%, passenger vehicles count for 7%, and financing at 2%. The acquisition of Jaguar and Land Rover basically was a massive acquisition and brought in a huge amount of volume relative to what the company was initially doing. Now, if we look at the breakdown by region, the company is selling 20% of its vehicles are sold into India. United States, 19%, China, 18%, UK, 15%, EU, 14%, and others, such as Thailand and other markets around the region, are at 14%. So it is a pretty wide distribution. And now you can kind of see that if 78% is Jaguar and Land Rover, 20% is in India. So a lot of what's happening outside of India is those brands. So what's the story with this company? Let's try to piece together the story. Well, restructuring is challenged by immense cost pressures. What do you see? Tata has been loss-making for the past 3 years, mainly due to inefficiencies of its subsidiary, Jaguar Land Rover. The 5-year average operating margin is about 2.3, which is far below competitors. And basically, under its reimagined strategy, Tata puts a high focus on reducing costs. That really is going to be the key. We can see that the SG&A and the COGS are critical, and the EBIT margin in 2021 was at 2.2, a very, very low. Recall that EBIT margin for companies across the world is about 10%. Now, that's different by industry. I think industry for the car industry is about 6 or 8% for EBIT margin. So it has to cut back its Capex program and aim to reduce its labor force. So let's look at Capex. The Capex cut should help to improve profitability. This chart's very interesting. The first thing you see is the right-hand scale is the bar. That's the Capex divided by depreciation. And then we see the actual Capex expenditure, which we can see is falling, the blue line, and then the adjusted depreciation is the green line. Now, Tata continues to cut its Capex program in its attempt to enhance efficiency. This means that Tata quit its strategy of growth at any price. The focus is now on reasonable investment with high margin. But this also means that it's leaving its high growth stage. If you're not doing a lot of Capex, it's hard to grow. Now, let's take a moment and look at Ask a John Andrews section. I want to talk about Capex to depreciation ratio. First of all, for growth firms, the Capex should be more than the annual P&L depreciation charge, maybe 150%. In other words, Capex should be at least depreciation, which would be 100%. If it was 100% of depreciation, it would mean that the Capex is just enough to maintain the existing equipment. But for a growth firm, it could be, let's say, 150. There's more Capex than current depreciation. Now, what about very high growth firms? Well, Capex could be much more than 150. It could be 300. It could be 500, depending on how much they're spending relative to how much assets they have in place. What about a low or no growth firm? Well, Capex in that case is going to be about equal to the annual depreciation charge. So that's what the Capex to depreciation ratio can tell us. I talk a lot about that in the Valuation Master Class. Now, let's talk about this pure play approach to ride the EV momentum. First of all, what you can see here is the structure of the new business. And what you can see is Tata will set up a new subsidiary in 2020 and in its attempt to move forward with EV. This entity is separate from other passenger vehicles, and it raises about $1 billion new in capital through the private equity fund of TPG Rise Climate. They're getting about 11% stake. This means that Tata's EV business is roughly valued at $9.1 billion US dollars. Tata's share price on the announcement date jumped by more than 20%. So there's a demand rebound, and that's making up for some lost production. What you can see here is the new capital will be used for the battery development, charging infrastructure, and manufacturing. The red bar here is the electric vehicles that Tata is selling in India, which in 2020 was a little bit more than 1,000. Then it went up to 4,000 by 2021, and now it's expected to be about 7,000 for 2022. By 2026, Tata plans to roll out 10 electric vehicle models. This should help to bring EV contribution to 20% of total sales by the end of 2026. Also, Tata is likely to maintain its current dominant market share of 70% in India. So let's look at easing of supply constraints, fostering a rebound. So semiconductor shortages have led to a limited production of about 64,000 vehicles of its subsidiary, Jaguar Land Rover, in 2022, second quarter. This is down, and their annual numbers are slightly different than the typical fiscal year end. This is down about 18% year on year. However, at the same time, it recognized a record order of 125,000, which ensures strong revenue in the near future as long as those people don't eventually leave. But the point is, the demand supply is in imbalance right there. Riding the demand wave could bring double-digit revenue growth for the next 2 years. All they need is those semiconductors. Now, to download today's slide deck, you can find it in the blog section of the Valuation Masterclass, or just scan that QR code. Let's look at the Fvmr Scorecard. It measures a stock's attractiveness relative to all other companies. Attractiveness is based on 4 elements: fundamentals, valuation, momentum, and risk. And we look at a scale of 1 best to 10 worst. Here we can see the Fvmr Scorecard, and at the top of this scorecard, it's about neutral. Fundamentals, a little bit below neutral, meaning a little bit worse than neutral. Valuation, about average, and momentum, very strong, and risk, getting weak. In fact, the level of net debt to equity is rising quite substantially for the company. Now, let's look at the momentum in a little bit more detail. What we can see is revenue growth at 32.9 is pretty substantial, and we see the EPS growth and the margin change also. But more importantly, we've had a very strong run in the share price. That strong run in the share price probably makes investors be a little bit cautious right now. Now, recently I've created a short online course explaining my FVMR approach. It's a $97 value, but I'm offering it for free here. Just scan that code and you can go there and you can learn about FVMR and how you can apply that in your investing. Now, let's talk about forecasts. Here we can see that consensus remains optimistic regarding the recovery. First, let's look at the recommendations. What we can see here is strong buy and buy are the main ones. There are 5 holds out of a total of 30 analysts. And basically, the upside is about 7.3% if we look at the median or the mean target price. And analyst consensus does not see much further upside. The stock price has shown strong momentum recently, which is good, but they're optimistic that Tata can converge its profitability to its peers over time. That's the one thing you can see. If you look at the EBIT margin here, it's going from 1.9 to 5.9 to 6.5. So analyst consensus forecast is pretty optimistic. When you consider that EBIT was 0.2 in 2008, negative 0.5 in 2019, and 2.2 in 2020, it's hard to see that this is going to get to 5.9 and 6.5. So I would say analysts are probably overly optimistic. The profit and loss statement, well, we did a little bit of forecasting here, and we looked at it and said what we think the net profit's going to be. It's likely to recognize, in 2022 for the 4th year in a row. However, that basically means losses for 4 years in a row. However, we expect that the company can turn around its profitability in 2023. So we are trying to be optimistic in this forecast. So strong car sales and enhanced cost-cutting program should lead to a higher margin. Now, let's look at the balance sheet assets. The company has a strong cash position. That's good. It's holding around 19% of its assets in cash. And net fixed assets grow gradually as Tata has committed to slowing its Capex program. Here we can see liabilities. It's got a relatively high level of leverage. Liabilities to asset ratio is about 82%. That's very high, really, when you look at the sector. Retained earnings continue to decline in 2022 as Tata is likely to record a net loss again. And we are forecasting a turnaround in 2023. What about the cash flow statement? Well, given its losses over the past years, it did not pay out any dividends since 2016. And we assume there'll be no dividends coming out at least for the next 3 years. Let's look at some of the ratios. We can see that we're expecting some recovery to happen in 2022 and 2023. The net margin could finally turn positive. We're saying about up to 2.4% by 2023. And Tata has been among the worst or lowest profitability car companies in the world. We can see the EBIT margin and saying that it would be a challenge for that EBIT margin. Even to get up to 5 in 2023 is excellent, but to get to 7 to 9 for the industry average would be very difficult. The company has relatively high leverage. Also, we can see net debt to equity is relatively high at 1.6, and the most recent was 1.3. But given that the company is making a loss in 2022, that 1.3 is going to go up to 1.6. And then free cash flow. Despite the net losses, free cash flow has remained positive. And if we look at Capex, we can see that free cash flow is likely to stay positive based upon not too aggressive Capex. So before we get to valuation, I would say, what would you say about the turnaround of this company? What we can see from the research so far is that the company is definitely struggling. And the question is, can they really turn that around and move to a substantially higher level of profitability? That's what analysts are forecasting. So let's look at that in a little bit more detail. If we look at the value estimates that we wing, here we can see that global car sales is likely to see a strong rebound over the next 3 years. Profitability is suppressed in the short run by higher raw materials cost and the semiconductor shortage. plus cost-cutting measures implemented by Tata may take time to impact. Now, what we're looking at is the valuation method of free cash flow of the firm. A risk-free rate of 7.5, equity risk premium of 5. That means a market return that we're expecting going forward for India of 12.5, a beta of about 1.25, and a cost of equity of about roughly 14%. This also gives us a WACC of about 9.5, and a terminal growth rate will plug in of 4. Based upon all that, my value estimate is about 447, which has a downside of 10.1. In other words, it's not attractive relative to the base case or the best case. Well, let's look at the best case. The best case is the bull case. And here we can see that the target price goes from 447 up to 479. And that's an upside of only 3.6%. Not something to get that excited about. And in the bear case, I would forecast a downside of about 16%, with the base case price at 447 and the bear case price at 416. Let's look at the company's world-class benchmarking scorecard. It identifies a company's competitive position relative to global peers. It's a combined or combination, a composite rank of profitability and growth. I call it profitable growth. From a scale from 1 to 10, 1 is best, 10 is worst. So it's ranked among the worst companies in the world when we compare it against 1,000 large consumer discretionary companies worldwide. Remember, this comparison is not looking at just car companies, but all large discretionary companies. And we can see that profitability is very weak and the margin is low. And what we can also see is that growth is starting to rebound. At 5, a ranking of 5 for the past 12 months for growth means about average level of growth relative to peers. What about the risks? So, ongoing supply chain disruptions create shortages, especially semiconductors, and increase production costs. The failure to implement adequate cost-cutting measures is very, very real. And the electric vehicle investment may not be sufficient to keep up with the competitors. So let's go back to where we started. Restructuring is challenged by immense cost pressures. Pure play approach to ride the EV momentum by setting up a subsidiary company that or a company that they're able to own a large amount in, and they got one investor in for EV. They brought some buzz into that. And the easing of supply chain constraints fosters some revenue rebound. The key statistics, well, there's 30 analysts covering the company. Their target price is 535. That's a 7.3% upside, and that is firmly a hold. Price to book is about 2.1, and dividend yield is 0. So analysts aren't particularly impressed. So my conclusions, well, value addition through newly formed EV subsidiary might be overhyped. Share prices already moved a lot based upon that, and they have a lot to deliver. Also, slowing Capex plan could constrain production growth. And finally, no dividend policy requires a return generation you're going to get by investing in it coming from the price. So let me ask you, based upon all the information that you've just seen, can the world's least profitable car maker turn around? That's the question, and I would love to hear your answer. Feel free to leave that answer in the chat below and let me know how it goes. In addition, if there's any company that you would like me to value and go through, just let me know and I'll be happy to do it. Have a great day and keep on valuing.